Good morning and welcome to Business Morning this morning. Today we're going to be looking at markets, key developments shaping investor sentiment as we look at what to expect from trading today and the major economic and business stories, driving the agenda. Then Nigeria's capital market is undergoing a fresh wave of regulation, and we'll examine the new rules changing how Nigerian stocks move, the SEC's approach to virtual assets, and efforts to unlock the country's growing pool of unclaimed monies. We'll also look at the rapid rise of stablecoins and ask whether Africa is building the next generation of global payments infrastructure. A lot to unpack this morning, but first off, let's kick off with what's playing up in the oil market. Now, we've seen oil prices, there were little change today after surrendering earlier gains as optimism over talks to reopen the Strait of Hormuz that was tempered by Iran's insistence that the United States satisfy several demands before the waterway could reopen. And we're seeing Brent there 0.16% higher this morning, $83.68 a barrel. WTI still sub 80, 78.30, just about 1 basis point higher at the time we took the numbers. Definitely a lot of volatility right now. That might have changed, so far. But let's look at how the oil market performed last week. Definitely was a red performance. That's for the weekly chain. There we see Brent was down a whole 9.16% last week, closing at $84.43. And WTI double digits there, 11.20% down, closing at $77.07. Gold and silver, they did shine last week. That's for the metals market there. So that was how it looked last week. We'll see if this sentiment continues into this week. That's talking about oil market. Definitely at the pumps. Would love it to remain this way, but for government revenue, no, we need oil higher. All right, we see Nigeria's equities market ended the week marginally higher. That was last week with bargain hunting on Firstholdco, Zenith Bank, and MTN Nigeria, helping offset significant losses in ETI, Dacty Sugar, and Transcorp. The NGX All-Share Index rose 0.1% week on week to 245,000 points, taking year-to-date gains to 57.8%. That's how the market performed last week, talking about the NGX. There you have it. Then we see trading volume also increased by 9.1%, although trading value plunged about 64.7%. The banking sector led the gains. That's for the sectors that we track, rising 2.4% for the whole trading week. That's for the sectors, while insurance, consumer goods, stocks, that came under pressure this week. So banking was the lone gainer for the sectors that we track. That was for last week. Then meanwhile, we see the Nigerian exchange, they're setting their sights even higher. With the NGX Group CEO, Mr. Temi Popola, projecting that the market value of listed companies could reach 230 trillion naira by the end of 2026. The projection comes as the market has expanded significantly, with listed equities now valued at about 160 trillion naira, up roughly from about 30 trillion. That was in 2023. Mr. Popola says major anticipated listings, including the Dangote refinery, alongside sustained investor interest, could drive the next leg of growth. And we've seen Nigeria's tax collections have more than doubled in less than 3 years, rising 113% from 12.3 trillion naira in 2023 to about 27.1 trillion naira as of July 2026. The Nigerian Revenue Service attributes the surge to digitization, 4 new tax reform laws, transformation of the revenue service, and measures to close tax loopholes. The Revenue Authority says these reforms are helping move the economy towards greater stability and resilience. And we see Nigeria's foreign exchange market is showing fresh signs of improved liquidity, with total inflows rising 59% month on month to $4.4 billion in July. Domestic inflows more than doubled to $2.9 billion, with the CBN emerging as the biggest contributor, increasing its FX sales to about $1.4 billion. Exporters also boosted supply, while corporate dollar inflows, that rose about 38%. That's recent data right there. And go back to tax now. We've seen taxpayers can now contact the Office of the Tax Ombudsman for complaints and disputes pertaining to tax issues. Since creation in 2025, however, So far, they've received a total of 20 genuine cases via email, via the web portal case, and 5 were submitted physically. The chief executive of the Office of the Tax Ombudsman, Dr. John Nwabweze, who met with journalists for the third quarter 2026 breakfast meeting in Lagos, said that since creation in 2025, his office has received a total of 20 genuine cases, 12 received via a web portal case management system, and 2 via email. Take a listen.
The law says gives us a time frame, and that is 14 days from the first day we receive a case. And between my legal and the operations department, I challenge them to be sure that we keep to that timeline. And I can tell you today that all the cases resolved were under that timeline, even in spite of the fact that we had to go back and forth, and that was very good. So the law allows a 7 days extra time to have issues resolved. So when this 14-day window closes, we can request a 7-day, and hopefully within 3 weeks we should be able to resolve a case. That's what happens now. But when you look at systemic issues, the timeline does not apply to systemic issues. Sometimes it might take close to a year to even begin to resolve such systemic issues. But when it comes to very personal, individualized cases, yes, 14 days and an additional 7 days. And in terms of services being free, that's the way the law was couched. And that's why we are actually public servants. So we provide the services free. And yes, it's not a private sector driven office. And so the law now allows us to provide those services. In the office, we have all the departments. We have legal, a fully well-staffed legal department that handles such cases.
All right, let's head on to our first conversation now. See, Nigeria's capital market is entering a significant regulatory phase. The SEC is simultaneously trying to get more investors to claim monies and inherited investments, strengthen the framework for virtual assets, tighten market conduct, and improve price discovery. The conversation is particularly timely because NGX's new stock price movement methodology that takes effect on August 17th, not far off. Following SEC approval, under the new framework, only trades meeting specified minimum volume thresholds will trigger published price movements for 10,000 units for stocks at 1,000 naira and above, 50,000 units for stocks between 500 naira and 999 naira, and 100,000 units for stocks below 500 naira. That's price. Existing daily price movement limits, remain unchanged at this point. Join me now to unpack this and other matters. We have Dr. Momotimi Agama, the Director General of the Securities and Exchange Commission, and joins me via Zoom. Great to have you on the show, sir. Good morning.
Good morning, and thanks for having me this morning.
Yes, sir. So first, let's start with the new stock price movement rules. Now, that takes effect August 17th. That's not far off. First off, why was this change necessary?
Well, the price movement regime will actually change as a result of request and the movement of stocks, and more importantly, the level of volatility that we're experiencing. This is being looked at critically to make sure that no market operator or no institution, makes a loss as a result of the activities that are happening in the market. Beyond the fact that we had earlier given approvals, we are still also taking a second look at those activities before a final date will be announced. I believe strongly that from feedback that we've gotten, we need to do a deeper look at those rules and the approvals that we have given. So we probably will have to take a second, a flashlight on the issues.
So how will the SEC monitor, whether the new methodology, actually improves, price discovery? Because I know this is one of the major, reasons, for this. How do you monitor to make sure it's actually, reflecting?
No, the SEC has some new technologies and, of course, more savvy individuals who will be dedicated to making sure that whatever we have approved is actually implemented.
All right, definitely we would be, tracking that. But, for investors, in your mind, what do you think investors should expect, from this new methodology?
What investors should expect is a more efficient market. What investors should expect is a more transparent market. What investors should expect is a market with integrity. At the SEC, one of the things we want to continue to ensure and assure investors is that we will definitely have their back. And in doing that, we must also take into consideration the feedback from all stakeholders. And so at the point, we all definitely should be on the same level playing ground in order to be able to deal with the challenges of moving the market to the next level.
All right, for investors, look out there, August 17th. We'll see those new price movements there, the new volume threshold.
Yes, so let me make a point here. August 17th is not sacrosanct as of today because of the feedbacks we've received, but be rest assured that as we continue to engage a more detailed information, we will provide to the market.
All right, thank you for that update, sir. All right, let's pivot to another matter now. We see the July 2026 Presidential Executive Order on Virtual Assets Coordination, seeking to harmonize regulation, cooperation among financial, revenue, and capital market agencies. We see the SEC continues to regulate the capital market side, of digital assets, with the new coalition at this point. But where exactly does the SEC regulation of virtual assets? Talk to me about where it begins and where it ends.
Yeah, thank you. That clarification is important. If you read through the executive order, you will see therein it was stated copiously that the powers of the individual institutions as provided by the law remains what it is. And so, where does it start? Where it starts will be where our history starts. In September 2020, we came out with a classification and clarification circular, identifying and specifying clearly what the SEC will be doing within that space. That was an important step in trying to give people clarity, which was missing or lacking at that point in time. So, moving forward, fast forward, we came out with the Virtual Asset Service Providers Regulation. And with that also, we are at least trying as much as possible to give more clarity to the situation around the regulation of the virtual asset space. And come 2025, March 2025, and the signing into law of the ISA 2025, it was now legislated that the digital asset space, when it comes to securities regulation, falls under the SEC. The payment systems regulation falls under the Central Bank of Nigeria. And indeed, of course, the AML-CFT responsibility is with the NFIU, and the collection of tax with the NROS. And indeed, the issues around security clearance goes to the ONSA. So clearly, the executive order does not diminish the powers in the laws of the various institutions. What it has done is to provide a coordinating framework, a rail wherein every regulator, every party that is concerned with the regulation of that space is properly informed and decisions are taken without arbitrage. So it is very clear our responsibility. Where it starts is securities regulation, where it ends is securities regulation.
Right, and DG, definitely when it comes to regulating, cryptocurrencies, digital assets, or even taxing them, it's one that everyone's still trying to wrap their heads around at this point. But for you, would you say regulating digital assets, would you say it's getting easier in a country like Nigeria, in your opinion?
Yes, it is getting easier, and the reason why it is getting easier is the wisdom of Mr. President to sign up that regulation for coordination. The only reason why it will not get easy is when people are acting differently. But this time around, you find out that the president in his wisdom has signed out that executive order to put everybody together and put our house in order. So once we see each other, if there are any areas of overlap, it is our responsibility as a council to make sure we smoothen those areas and provide information as at when necessary, in order for people to get a proper vision and picture of what regulation is all about within the space.
Right, and when you look at regulation from your side, do you think the stakeholders will be happy with whatever you come up with?
The stakeholders will usually be happy because regulation from the SEC side is about consultation. A broad-based consultation is always, our principle and our way of dealing with regulation. And so our rules will usually be exposed to the public and we will elicit comments from the public, and upon the consideration of those comments with technical expertise from the staff of the SEC and indeed other important stakeholders before we come out with rules. So a rule that is built around the people, a rule that is built around the operators, a rule that is built around the participants certainly will be a rule that is acceptable to everybody. And that's exactly how we run our rule system, and of course that for us is the way to go in building transparency, trust and integrity within the regulatory sphere.
All right, DG, let's move to another matter now. Unclaimed dividends, unclaimed monies. At this point, most of the time I get calls from some investors say, I've not gotten dividends in a long time, from this stock that I own. It's mostly unclaimed, at this point. How do I, go about it? DG, how has it been so far? How large is the unclaimed dividend problem today, unclaimed money problem today? Is it getting better? Do you think investors are able to claim some of those funds at this time?
It is getting better. It is getting better because we have now instituted mechanisms to be able to get it better. Our responsibility is to investors. And one of that responsibility is to make sure that investors get what they desire, what they deserve, and exactly the returns for their investment, which are usually and sometimes become unclaimed as a result of poor addresses, as a result of the non-update of their information, as a result of poor bank account information, as a result of not having a BVN. There are several instances and reasons why you have that unclaimed dividend piling up. And the reason why we have decided to take it headlong is because we don't want it to be a menace. We want to instill confidence in Nigerian investors to say, look, if you have invested and you have dividends, you should have your dividends, with you or in your bank. So that is why we have gone out to do what we are doing. Before that, it's important to state clearly that at the SEC, we decided to establish an office called the Office of Unclaimed Monies. That office will directly interact with people who have these challenges. But that was not enough for us because we discovered that it did not really get to the grassroots that we desire to meet. And so what did we do? We now started an outreach program that is that is expected to cut across 36 states of the Federation. That has been going on very well. And we believe strongly that if we have not gotten to you yet, we will get to you. And one other thing we decided to do in that process is to invite every registrar. The registrar that it would have been difficult for you to reach out to. All of those registrars will be at that venue to deal with any of those challenges that any of the investor was facing before now. So it is important that we are encouraging investors to take this opportunity to be able to get their monies back. It is their right, it is their entitlement, and so they must have it. And for the SEC, our responsibility is to make sure that that happens. So we'll continue to push to make sure that the unclaimed dividends go down. And we see that it is going down. It is not accruing as it used to be because of all of these efforts that we are putting up, and will indeed put in more efforts to make sure that Nigerians will benefit from their sweats.
And DJ, if an investor wants to get that information now, is it something that they can just go to your website and over there and find a port there where they can actually start the process of claiming some of these monies? Is it easy? Is it that easy?
Yes, it is that easy. Very well. We have a portal on our website that identifies your unclaimed money, which makes the things a lot easier. So once you go to our portal, our website, you find a portal that speaks to unclaimed dividends. You put in your name into that portal. It will bring up all of your unclaimed monies, and then of course even the registrars that are concerned with that unclaimed monies, and you are expected to fill those forms. So we are as much as possible getting it easier, and we certainly will make it easier. But if there is any challenge, the SEC is just a phone call away, and certainly we will be able to deal with it.
All right, go out there and claim that money if it's yours at this point. Thank you so much, Dr. Momotimi Agama, Director General, Securities and Exchange Commission. Thank you for coming on the show today, sir. All right, so there we unpacked a lot there with the SEC DG from regulating digital assets to claiming some of those unclaimed dividends. But now let's pivot to another conversation that's still within that line. What started primarily as a tool for moving value around digital asset markets is now being positioned as a new rail for cross-border payments, treasury management and settlement. And Africa is emerging as an important testing ground with multiple currencies, fragmented payment systems, and the high cost and complexity of moving money across borders. The continent has some of the conditions where stablecoins can offer a practical alternative. Global financial institutions are now taking notice. Likes of Standard Chartered, for example, they've expanded their institutional stablecoin capabilities, while African-built fintech infrastructure players are building the connections between local markets and global digital payment rails. So why are global financial players betting on infrastructure built for markets like Africa? Joining me for this conversation now, we have Lasberry Ludimu. She's the MD, Yellow Card Nigeria. She joins me right here in the studio. It's great to have you. Good morning.
Good morning, Ladi. Always a pleasure to be here.
It's been a while, and definitely a lot has played out so far. And I'm sure you did hear the SEC Director General there. I know before now, SEC, digital assets, they have this strained relationship, but I think things are getting better. How's it looking in your opinion?
Yeah, things are getting better, and it's quite interesting that at this point we can now approach the regulators, and the regulators are actually doing a whole lot, right, to ensure that the good players actually do business in a very comfortable environment. So I really commend what the SEC is doing, as well as the other regulatory bodies, to ensure that this space is well regulated, because that's actually how we can grow, that's how we can scale. Without regulation, we can't scale. So Nigeria, being the biggest economy in Africa, is also expected that we have a very robust regulation in this ecosystem, and the SEC has just taken that and ran with it, and we're so excited what the future looks like for us in this ecosystem.
The council is moving.
Exactly.
At this point, and we see the NRS also moving.
Exactly.
Looking at taxing crypto.
Exactly.
At this point, and digital assets. So let's piggyback to what Standard Chartered, did recently, and other global financial players. They're choosing African-built stablecoin infrastructure companies to actually, move monies around, because when you look at, crypto, it seems or digital assets, it has moved from, buying Bitcoin, trading, and making profit. Now it's stable coins, moving money across continents and countries, at this point. Talk to me about this latest one.
Okay, so the global financial institutions, the key interest there is not to invest in Africa, right? But the key interest is basically the stablecoin capabilities, what stablecoin can do in this financial institution, for these financial institutions, right? Just like you said, when stablecoin came in earlier, it was basically used for buying other digital assets, right? Some people were using it for price discoveries and all that. But what we are seeing these days, or what we have seen, is African businesses, African fintech, that have actually taken stablecoin and built a whole lot of strong products around it, right? So stablecoin is no longer used for price discovery. Stablecoin is not used to buy Bitcoin, like you said initially, but stablecoin is now used as a payment rail. Stablecoin is now used as a means of managing your treasury. So what the global financial institutions have seen is the use case for stablecoins beyond the use of stablecoin to buy other digital assets. There's a whole lot of problems that stablecoin is solving. And if you look at what the African fintechs are doing, it's like we have built something that has been recognized globally, right? We have built something to solve our own problem in Africa. Like Africa, we have about 54 countries, and within the 54 countries, we have about 42 currencies and all that, right? So we're not just dealing with currency volatility, we're dealing with multiple currencies. We're dealing with fragmented payment system. We're dealing with fragmented regulatory framework, right? So what we have done, like a company like Yellow Card really, is to come together to say, what can we really use stablecoin to do? How can we use stablecoin to solve the African problem? And now we've been able to do it. Now the global institutions have now seen value in it. If we can solve the problem, the legacy problem in Africa, and don't forget, they're also experiencing most of those problems because they have business that they serve that are also within the African continent, not just within the African continent, also within the emerging markets. And we're facing almost the same problem. So if stablecoin is solving this problem for the Africans, it can also solve the same problem for the emerging markets. And given that the likes of StanChart, they have businesses across the world, they have businesses doing also some businesses in Africa, emerging markets, and even the developed economy. That is why they are now interested to solve the hardship that the legacy or the hardship that the traditional finance has actually caused on those businesses. So it's actually the value they are looking at and not interest, not really investing in Africa, but they want to utilize and they want to be part of that ecosystem. They want to see the capabilities and even expand it beyond what African fintechs have done.
It's quite interesting. I remember many years ago, we're talking 10, 11 years, the whole point was decentralization. Bitcoin, stable coins at that time, it was all about taking out the middleman. And when they talked about the middleman, it was about taking out the banks. But now we've come to a time where we're actually seeing the banks actually find a use case, for this. But the thinking, back then was this was disruption for, traditional finance. But it seems we're moving from that.
Yeah, that was actually a misconception, right? You will never take out the traditional finance, right? What stablecoin has come to do is to improve the efficiency, is to make them to be able to move funds in a more efficient manner, saving costs as well as saving time, right? Just while I was seated downstairs, I had this invoice that was being processed on 3rd of last month, right? And today is about 10 or 9?
10th, yeah.
Good. The beneficiary hasn't received value. The invoice was sent to us on 31st of last month, 31st of July. This is 10th of August. The beneficiary hasn't received value. And when I looked at the history, I've discovered that that payment has actually passed through about 3 to 4 intermediaries. The beneficiary is still waiting to receive value, right? So just think of using stablecoin. What if you had used stablecoins for this transaction? It would have just been received the same day, in minutes. right? So we're not going to do away with the bank. Stablecoin is not in competition with the traditional finance. Rather, stablecoin is complementing the traditional finance.
Right.
So the banks will always be there. And what they can do with stablecoin is just to improve their efficiency, just to reduce cost in moving funds around, and also reduce the timeline for moving funds around.
Yeah, it's
so
quite
the banks will
interesting.
always be there.
It's quite interesting how stablecoins, they can move in seconds, across continents and all of that. But with what's playing out, at this point, what are you seeing, going forward? Do you think, does this technology evolve, or does it remain the same, in your mind? Because now we're still talking about artificial intelligence at this point, investment in data centers and all of that. Where are you seeing stable coins?
It will definitely evolve, right? Now, because global financial institutions are jumping in, everyone is exploring, everyone is trying to be innovative, right? What we see presently is financial institutions and businesses using stablecoin for cross-border payments, treasury management, or maybe merchant checkouts, right? Businesses are still building. There are still innovations around stablecoins, right? What it will be in the next 5 years, I'm not sure I know that. But one thing is clear, there will be a consistent innovation around stablecoins, right? So what I would say is, let's deal with what we can use stablecoin to do right now, right? And don't forget that there is also, like Doctor also mentioned, there's always a place for regulation, right? And because we want to, because we want to take advantage of the speed as well as the low cost benefit you can get from it, we can't trade compliance for speed. So there has to be regulation, which is what the SEC has been pushing for, which is what the SEC has actually been doing, right? So there will consistently be innovations around stablecoins. As I sit here, we're also thinking about additional products to build around stablecoins. So the journey is too far for us to know.
It's
Exactly.
still quite far.
Yeah.
All right, but definitely, we keep tracking regulation, and that also seems to be evolving. Also, everyone's still trying to wrap their heads around regulation and taxing. We're seeing latest talk from the NRS here in Nigeria, looking for ways to actually tax, cryptocurrencies, stable coins, and all of that. Do you think, are you seeing risk ahead, when it comes to, regulation? But before you answer that, we're going to join a live coverage now in Bauchi State, commissioning of township roads and a groundbreaking of parks. That's for our DSTV subscribers. You can still follow the money right here on all other platforms that we stream at this time. So are you seeing risk, at this point?
Ladi, this is the whole, whatever we're seeing now is natural. There's nothing strange about it, right? We have seen it in different markets. We have also seen it in Nigeria. When we have innovations like this, there has to be regulation. And when regulation comes up, obviously we don't expect the regulators to get 100%. That's the place of amendment, right? That's the place of having conversations with stakeholders. So there will be regulations, like the DG said. Most times when regulators publish regulations, most times there has been some conversations with stakeholders, right? But that doesn't mean the regulators will not remain regulators, because there's also something they are looking at, they are saying that we're not saying, right? So there is a place of engagement. There is a place for consistent discussion. If things are not right, if you think, oh, this shouldn't be this way, then we should sit around the table and talk about it. So this is not the first time we're seeing regulations, and we'll keep seeing regulations. So as we innovate, as we explore, the regulators will always come up with one regulations or the other. But at the end of the day, we'll all smile and shake hands.
Fantastic.
Yeah.
It's great. Great place to anchor it there. Thank you so much, Lasbury Ludimiu, MD, Yellow Card Nigeria. It's great having this conversation with you.
Thank you so much, Ladi.
All right, and after a quick break now, we'll come back. We'll also piggyback on some stakeholders in the digital asset space, what they're saying about taxing crypto. That's next. Do stay with us. So Nigeria wants to bring a large and growing digital asset economy into the formal tax system. Some digital asset stakeholders agree with that objective, but warn that taxing transactions rather than profits could push users away from regulated platforms and towards offshore exchanges, P2P transactions and other less visible channels. That creates an interesting policy question. Can Nigeria increase tax revenue from crypto without driving activity out of the formal economy? Joining me for this conversation now, we have Martins Okebugwu, the spokesperson, Digital Asset Coalition, and he joins me right here in the studio. It's great to have you. Good morning.
Thank you. Good morning. Thank you for having me.
Yeah, so many years ago, definitely in this industry, there was always talk about how taxing digital assets, what that would look like. But we're here now, and we're already seeing the regulators trying to put out some guidelines at this point. Let me start with the headline now. Is the Digital Assets Coalition, are you opposed to taxing cryptocurrency in Nigeria? I know you represent them. What's the game here?
All right, thank you. We are not opposed to taxing. If you're doing business within a jurisdiction, it does make sense that you actually pay tax. What we are opposed to is taxing movement of money instead of the profit thereof. And then, of course, that goes to also say that we are excited that about the policy direction already. Prior to this time, we had a lot of uncertainties with respect to regulation, but clearly the body language of the regulators is that they want to actually regulate the industry and then be able to get the best out of it. So we are not opposed to tax.
Right, and definitely you see you don't like the 1.5% duty. I see you're against that. Your association is against that. So it almost seems like, are you looking for preferential treatment here when it comes to taxes? Okay. That's for the digital asset space.
All right, I think it's not preferential treatment. If you ask me, we are looking for some level of fairness compared to what is also done in the traditional sense of things. For example, if you move 10 million naira today from your bank to another bank, the stamp duty is about 50 naira. That's about 0.005% or thereabout. But in this case, you're paying 150,000 for the same transaction, amount of transaction. Of course, what that means is that people will be looking for every other avenue to move money but crypto. Now, and in this case also, it's a two-edged sword. This is how it works. If I want to buy crypto from an exchange with Naira, now, because I'm the recipient of that crypto, I am taxed 1.5%. And then, if it's the other way around, and I'm selling crypto to an exchange, because the exchange is the recipient of that crypto, they are taxed 1.5%. Now, if you look at it globally, there is no exchange that even makes as much as 1.5% on any transaction. There is none, right? Interestingly, yesterday I was watching Channels TV, Sunday Politics, I believe, and Mr. Zach Adedeji was on that program. One of the things that, great man by the way, very intelligent and an excellent man, one of the things that he said that stood out for me was that the whole intention of their approach is to tax prosperity and not poverty, to tax the fruit and not the seed. But you're talking about preferential treatment, but how we feel is that the entire tree is actually taxed right now, and that's what we're actually coming to say, that it will be difficult for us to do that, because what happens in the end, we pass that fee or that stamp duty to the customers, and then the customers will not be able to carry it, and they will go offshore. And that would mean that even the tax that you're trying so hard to get, you will kill the local businesses, and then you won't also be able to.
So what would you say is the best way around this, so that we get some kind of win-win scenario?
Okay, let's even talk about the withholding tax as well, because it's being able to marry both of them, and then we can move forward. Now, the withholding tax, I think one of the good things they actually did is the fact that stables are exempted from withholding tax, but then non-stables like BTC and I think category 1, 3 and 5 in their circular, they are the ones that are actually, this credited to the, the withholding tax, credited ahead of the end of the tax year. Now, what happens in this case? If I do a transaction of, I bought Bitcoin for 2 million, and then due to the volatility, I end up having 1 million at some point, and then I want to sell it off. What happens in this case? The exchange is supposed to withhold 1%, that is about 10,000 of that transaction. Now, I have lost 50%, and then I'm being taxed. Now, just picture it in the Nigerian sense of things, especially with social media. What happens? Because in this case, the customer will be after your life, because he has already made a loss and you're holding back his money. And there is no much education out there to actually explain to them that this money is not for the exchange, that you're to transmit it to an NRS and all that. So when you look at all of those, it's basically the fact that we are taxing the movement of money and not the profit, and that until we can even determine what that profit is, it's difficult for us to go ahead to even tax the profit, right? So one of the things we are saying is that they haven't gotten everything wrong, but there is need for the stakeholders to be brought on board to actually ask them what works, right? Because one of the things I had already mentioned is that we don't even make as much as 1%, let alone 1.5%, right? So a lot of these things are basically anti-growth.
Okay.
Yes.
All right. So definitely tax the profits not the movement.
Yes.
That's the message at this point. All right, consultations are still ongoing at this point. I would definitely hope that we all meet somewhere in the middle,
Yeah.
at this point.
Yes.
Thank you so much. Martins Okebugu is the spokesperson, Digital Asset Coalition. Thank you for coming on the show
Thank you
today.
so much for having me.
Fantastic.
Yes.
All right, now let's check out what's happening in the global space.
Good morning, everyone. Time to go global now. I'm John My Crown. We start from the United Kingdom, where we hear that the impact of the US-Iran war seems to be biting really hard. The price of petrol has gone up to the highest level since the beginning of the war. And one group that seems to be facing it more, even though it cascades to everybody, is the transportation that is bearing a bulk of all of that. We have a correspondent in London, Simon Pusey, joining us now. Hi, Simon. Good morning. I wonder how much it has increased by now, your transportation to and from the office.
Yeah, a very good morning to you. As you said, as of the 10th of August today, the latest figures put the average UK petrol at around 160 pence per litre. That's the highest level since the Iran war began. Diesel is actually considerably worse at roughly 179 pence per litre. £80 to fill a normal petrol car isn't quite a national economic catastrophe, but it is significant and it is a squeeze on household budgets. The bigger concern is that fuel is only really the first layer. If the oil shock continues, its effect will start appearing throughout the economy. So transport, deliveries, food production and flights, anything really that relies on petrol or diesel is affected. And something else that's also quite worrying is that the price at the pump tends to lag wholesale oil prices. So even if crude stops rising, or if it falls modestly, it can take some time for that to feed through to the forecast. So we may not have seen the worst of this yet.
Wow, that's unfortunate to hear. And this is even worse with what the Prime Minister has called fake discounts. And he says he's going to clamp down on that. What's this about? Issues around unwanted subscriptions and fake discounts?
Yeah, it's a real problem, but the evidence doesn't really suggest that UK discounts are fake, or that most of them are. The more accurate picture is that misleading promotions are widespread enough to matter. One striking example, let's just take a toothbrush, an Oral-B toothbrush advertised to loyalty customers at £34.99 versus £69.99. So that looks like a £35 saving, but which the consumer magazine and website found the product had actually been £34.99 for everyone immediately before and after that promotion. So the £69.99 comparison price gave a very misleading impression of the saving. For Andy Burnham, this is a quick and easy win. It's not going to save customers tons, but it will make sense and get good headlines out there. If you're saying you're going to tackle the problem, a win-win really for the government and consumers alike. But as I said, the scale of the win is pretty limited.
Yeah, well, talking about consumer protection there, and then I wonder if this is totally a good news. Britain's labour market report showing that recruiters have stopped shedding permanent staff, and there's a faster rise in starting salaries. Is this totally good news? And what's driving this?
Yeah, there are several things happening at once here, really. Some of the uncertainty seems to be clearing. So the Iran war, not as volatile as it was a few weeks ago, maybe. And also the Burnham bounce, the so-called Burnham bounce, seems to be giving people optimism politically. Also, businesses have been using temporary workers almost as a sort of halfway house. So companies aren't saying we don't need workers. They're more saying we don't want to commit to permanent headcounts. So temporary recruitment has consequently been a lot stronger. The June report recorded the fastest growing in temporary billings for more than 3 years. That suggests some businesses are now becoming sufficiently confident to convert at least part of that demand into permanent jobs. And salaries accelerating is an interesting point too. You might expect salaries to fall when there are lots of people looking for jobs, and there are still a lot of candidates available, but starting salaries are now rising faster. That tells us something important, that the labour market isn't uniformly weak. There are particular areas where employers still have difficulty finding the right people. For example, recruitment has picked up, particularly in legal, technology and accounting, while consumer-facing sectors such as retail and hospitality continue to be much weaker, and they struggle to find people. So I guess it depends on the sector when you're talking about jobs and when you're talking about salaries.
Yeah, all right. Thank you for clarifying that, Simon. And do have a good rest of the day.
Thank you very much.
From the UK, we move to the United States, where the president there, Donald Trump, has said that Washington is relying on economic pressure rather than new military strikes to push Iran towards making a deal. He said that Iran is in very bad shape financially, citing high inflation, difficulty paying its own troops, and credited the U.S. naval blockade in place since April with deepening that pressure. Mr. Trump also said that falling oil prices, now just about $75 a barrel, have eased the economic impact on American consumers. Still talking war now, Ukrainian drone attacks have struck almost 24 warehouses operated by Russian online retailer Wildberries, destroying the inventory and raising the possibility of a state-backed rescue that could affect the country's banking sector. And this is according to Wall Street Journal. The latest attack has sparked a fire at a warehouse more than 1,000 miles from Ukrainian front. The strikes have damaged over 1 million square meters of storage space since the campaign started in July. Ukraine has described the facilities as legitimate target, citing Wildberries' sale of military equipment. The company previously operated an online section offering bulletproof vests, helmets, and other products associated with Russia's war effort through the section, although the section is no longer visible. Merchants using the platform may have lost as much as $5 billion in inventory, according to Russian online retail research data. And in Asia, China's consumer price rose less than expected in July, while factory gate deflation eased, pointing to a still muted domestic price pressure despite recent signs of improvement in the world's second largest economy. The consumer price index, that's the CPI, went up 0.5% year on year in July, slowing from a 1% increase in June and reaching a 6-month low. This is according to official data from the National Bureau of Statistics of China. And then the reading is also along the forecast of economists. On a monthly basis, CPI fell 0.1% compared with expectations for a 0.2% increase and a 0.3% decline in June. The producer price index, which measures prices at the factory gate, that dropped 3.5% year on year, narrowing from 4.1% decline in June, but missing the expectation of 3.8%. And still in China, even by profit standards of an AI era, CXMT Core, their trading has debuted in Shanghai. Within a few hours, the memory chip maker, seen as Beijing's best hope of reducing reliance on foreign suppliers and challenging the US in AI, surged more than 500% to become the most valuable stock in mainland China, eclipsing Industrial and Commercial Bank of China Limited, which held the top spot for years. And still within that region, South Korea's economic growth for this year is expected to accelerate further on strong global appetite for semiconductors. And this is according to a survey analysts say ahead of the Bank of Korea's interest rate decision that's to be held later on this month. Economists estimate South Korea's economy will expand 3.3% in 2026. That's up sharply from a 2.8% forecast in July. And finally, let's see what we'll be expecting for the rest of this week from around the world. Talking about economic data today, it's the year-on-year Japan's bank lending. That's expected today. Year-on-year Japan's banking. On Tuesday, Italian trade balance. That's expected. And from the UK, the retail sales monitor should be out. And then there's the German final CPI. That's their inflation month on month. And US core CPI for month on month and year on year. That's on Wednesday. On Thursday, New Zealand, 2-year inflation expectation. That's what we expect. And, well, unemployment claims from the United States. Remember, the jobs report was out, and we saw that they lost about 73,000 jobs on Friday. So unemployment claims should be out on Thursday to see how much they're going to spend on that. And then on Friday, French final CPI for month on month, as well in Canada, manufacturing sales month on month, and business inventory. So that's expectation, the data that we expect this week. And of course, this will drive investor sentiment in the different markets. And those are the global stories for now.
Thank you so much for that. I will see right now trading NGX down about 0.13%. Stocks getting attention. Firstholdco, other banks there. Gold that's marginally up about 3 basis points. Bitcoin 0.28% higher. We'll bring you more updates at 1:30. Thank you for watching Business Morning. I'm Ladi Williams. Bye for now.